Well, good afternoon, everyone. Thank you so much, as always, for joining us for our industry update this month. I'm Jill Cox with Heritage Title. And per usual, Mr. Cox, my husband, Damian, is on the session. And before I introduce our guest speaker today, I want to start by making sure everyone's aware of our upcoming updates. We have been working diligently to start planning into next year. We're going to have a lot of great sessions. So coming up in December, this next month, we're going to have an HOA update with attorney Suzanne Leff. Damian, do you want to talk for a second about some of those HOA, some of the HOA updates and changes that are coming?
Yeah, well, we had a lot of things that changed in the legislature regarding HOAs this year, some good, some bad. What Suzanne's going to talk, so Suzanne represents HOAs, and so she's going to actually give a different perspective to brokers, because I know how much you guys love the HOAs, but she's going to try and give some perspective of what managers deal with, what's going on, probably talk about the new form. If you guys haven't seen the red line contracts and forms, there's a new association authorization form that she's going to discuss. Some of the pitfalls or concerns she might have about that, how it works, as well as some of the new legislation that talks about even fines being imposed on HOAs for failure to deliver documents. I don't want to get you guys excited because it's not that great, but at least it's something. So that's what we're going to talk about, is just some of the pain that you guys feel with HOAs and how to address it, and some perspective from the other side. So it should be a good session.
Perfect. January, we're going to take the month off. I think first part of the year, everyone's going to be kind of gearing up and doing some business planning and taking their annual commission update and their red line contracts classes. And then February 3rd, we have scheduled, it's going to be a really interesting session. We're going to be talking about wire fraud in real estate transactions, but we're going to be, our guest is going to be the head of white collar crime for the Denver FBI. So he's been a part of that organization for about 17 years, and he's going to be talking all about real estate, white collar crime, particularly wire fraud. So it's going to be super interesting. Please note that that session will not be recorded. They will not let me record the session, so you'll have to attend that one live if you want to see that session. And then finally, March 3rd, we're going to be talking about trusts and LLCs as sellers with Dean Roybal and Terry Williams, who are both underwriters with Heritage Title. So save the dates for that. And then finally, I'd like to introduce our special guest for today, Paul Bondy. We are super excited to have Paul with us today. Paul is the president of PBI Group, which he's a specialist in real estate E&O insurance. That is all he does. So PBI Group is a boutique insurance brokerage firm focused exclusively on the insurance needs of real estate professionals. And PBI Group has written over 50,000 real estate E&O policies for thousands of real estate companies throughout all 50 United States. So he is just an absolute expert in this realm, and we're excited to hear all the things that he has to share with us today. So if you've got questions, drop those in the Q&A. We'll get to as many as we can. And thanks again for joining us. And with that, Paul, do you want to take it away?
Yeah.
Get his presentation up here, and perfect.
All right. So, yeah, I mean, the way I usually do the presentation is that it's a little bit of a scared straight program where I talk to you about all the claims that are happening. And just to give you a quick background, on my program, I do about 1,000 real estate companies around the United States. And in 2019, we had 212 claims. In 2020, we had 414 claims. And this year, we're on pace to be a little bit over 800 claims. So that is what's happening in the real estate E&O claim market. It is an absurd confluence of factors that's pretty easy to identify, and hopefully we can give you some solutions on how to help it. But you know, essentially, if you're selling a home in 24 hours with 20 offers and no contingencies and no inspections, there are going to be issues, and the big problem is that you are responsible as professional realtors, whether or not the homeowner says, I don't want an inspection, whether or not the home inspector misses it. They will come back and say that it was your duty as a professional to have disclosed these things, to have recognized and noticed these things. So the number of lawsuits is really off the charts. And so what I want to do today is talk to you about the types of things primarily that I'm seeing coming up, things that are most likely to get you sued, and then, get Damian's input on the legal side of things.
Hey, Paul, before you go further, you and I have talked before about just the sheer volume of the claims. Can you give them some information about like what you're seeing with some of the carriers? I know some are leaving the space. It's been bad the last couple of years.
Yeah, a number of carriers. So the biggest carrier that left real estate E&O altogether was Hartford. They were a major carrier, and they left this year just because the claim volume and severity was too much for them to make a profit. Hallmark, Navigators, Ironshore. There's just a whole host of carriers that left the space. And eventually this is going to lead to a pretty hard market, sort of like what's happening in the real estate market. Smaller inventory means higher prices, and the same thing happens in the real estate E&O market. And so that's what we expect. Certainly if claims continue, it's not sustainable right now.
Yeah, thanks. I just think it's important people understand that it is not pretty out there, and that's not just Colorado, that's the entire nation.
Yeah. There are types of insurance that have earned the insurance companies the reputation that used car salesmen have, where it is tremendous profits, like the auto insurance business, where they're making so much money that they're returning money to people for not driving during COVID and traveling. There are parts in real estate, is not like that and never has been. The margins are super thin. The difference between a company making money and not making money is probably a single claim for any of these carriers.
Wow.
So let me get into the top types of claims. And so the number one is always failure to disclose water damage. And so Damian and I are going to have some disagreements on the remedy for this. But the number one thing I can tell you is that you're never going to be sued for over disclosing. It's never going to happen. So Damian might be able to pull up a case where somebody disclosed something they shouldn't have. But as a rule, you will never be.
That's the same advice I give them, Paul. So you're preaching to the choir there. You can't get sued for over disclosure, so you don't have to worry about that one.
Right. And how you disclose water, I think you proactively go out and try to make sure that they remember to put things in. Did you ever have a 5-year sideways rain? Did you ever have water coming down from your attic? Do you ever have blowers in your house? Do you ever have your dishwasher leak? I would personally try to help them remember, make sure it's your job to report it, even if the repair has been made, even if you suspect it and it wasn't disclosed to you by the seller. I would certainly talk to your broker about it, or your managing broker, and see if that's something you should disclose. Damian, you might have different input on what Colorado law requires.
Well, we have that seller's property disclosure, which is really the tool for helping remind sellers as to what they should be disclosing. But I don't disagree with you, Paul, as far as helping the sellers understand that, hey, nobody's ever been sued for disclosing too much. And if somebody's going to terminate a deal because they find out the dishwasher leaked, I'd rather know that ahead of time when you do the seller's property disclosure than get sued after the deal closes. So we do have a tool for helping us with that, but it is important that brokers have the conversation with their clients about filling it out as robustly as possible.
Yeah. The next issue, which I'm really surprised at, it accounted for 11% of all claims on my program last year, was the specific failure to advise whether the home was on city sewer or septic. That to me is pretty shocking because it seems like a virtually 100% preventable claim. to verify whether a home is on city sewer or septic, and not simply take the seller's word for it, to do some investigation to find out if it actually is on city sewer. Damon, any recommendations on how they would do that
Well,
or should do that?
Well, that's where I think you might, and I might diverge a little bit. The Colorado law says that the broker does not have a duty to investigate. I do think asking the seller pointed questions, are you sure that it's on sewer? Are you sure this isn't a case where you're on septic and a community well? Are you sure that this isn't a case where you're on septic and city water, where I've seen that before too? And that's where I think it gets a little tricky, but I've seen instances where they've had the water bill and looked at it and said, "Oh, okay, you're on Pikes Peak water, so we're fine." And then turns out that they were on Pikes Peak water, they weren't on septic, or vice versa. So, you just got to be careful in this, because I don't think it's the broker's obligation to investigate. If you do decide that you're going to investigate, make sure that you do it well. But my thought is still putting something in writing to the seller of, hey, fill out this completely. And if they say that they're on sewer and it's in a place that you're questioning whether that's true or not, follow up with another email that says, hey, are you sure? You said on here that you're on sewer. This is in an area that's typically septic. Would you please make sure that it is in fact on sewer? That would be my guess. Dan Hopper just talked about the source of water addendum. That one helps with wells and wells and community wells and city water, but it's not septic and it's not sewer. So those are the two that don't really fall under that source of water addendum. So that's my advice. It is an area that's tough, and hopefully brokers working in those areas know what generally it is, so that they can at least point the seller in the right direction.
Yeah, I think the main gist of it is that, if you walk away with nothing else after the conversation today, it is that really your job does not end with doing it in strict accordance with the law. That is maybe how you win the claim when you get sued. But, my job on the E&O side is to prevent the lawsuit from happening in the first place. And for that, I think it just takes a little bit of extra diligence and awareness of the types of things that are leading to the most claims, so that you can be a little bit extra careful. I go into all my calls maybe especially negative, where I assume everybody's going to sue me. And that's the way I defend myself. And I think if you assume you're going to be sued on something, you're going to be much more cautious, much more exact with your words, much more concise with your documentation, and vigorous about documenting everything, not doing conversations over text, but really making sure you document properly. Anyway, other areas of major concerns, HOA assessment issues and HOA permitting issues is quickly becoming top three, especially when you have issues with renting out places. Like if you sell a house that's intended to be used as a golf villa or a ski villa or something, and this HOA decides at some point that you can no longer use it for that intended purpose, and then the person who bought it for something that they can't even use it for, you're pretty much dead in the water when those things come up. Again, how you verify and corroborate any potential HOA assessments or permits or changes of usage, I'm not sure. Damian can talk about that.
Yeah, those are.
That, Damian?
Yeah, I'll tell you, that's something that's come up in the contract that they're trying to get better with, as far as assessments that the seller doesn't disclose. But again, to me, it goes back to the seller and just having that conversation about, are you sure there's no assessments? Or have you heard anything about an assessment? Or did you get your architectural control committee to approve your design on whatever you're doing? Did you get this? And making sure that it's in there. This is a tough one, just because, well, we'll talk about that in December, I guess I should say, because we'll have Suzanne Leff on to talk about HOAs. So
yeah, all right. Repairs, you're just much better off not using friends, giving the seller or buyer various options to protect yourself. I did have a large lawsuit where it was a $1,500 roof repair. The seller's agent just wanted to get the deal closed, brought in a family member who is a handyman to do some quick roof repairs. They did a shoddy job. The roof leaked. The leak sparked a fire. The house burned down. And it was something that they didn't report under the E&O because it was a $1,500 issue. They thought it was sort of a nuisance value, and they didn't want their insurance premiums to go up, so they didn't report it. And then the $450,000 claim to rebuild the home was, of course, denied because they never reported it. But it can lead to that type of thing. Bodily injury, property damage. This could be falling down at a showing, somebody getting bit by a dog at a showing, bodily injury from mold, lead, radon, asbestos, carbon monoxide fumes, property management issues where you don't, somebody falls down a staircase and says you kept it in disrepair. You're showing a foreclosure property in disrepair and somebody falls down and gets hurt or trips over something. So bodily injury and property damage are, again, certainly top 10. I'm not sure if they're top 5, but awfully close. Escrow issues, not a lot you can do about it. Oh, good.
Hey, are you gonna speak on the coverage issues with bodily injury and property damage or later on, or should we discuss that now?
We can jump over if you want me to do that.
Well, that's okay. Let's get to it later if you're going to talk about it. I just want to make sure we cover the fact that that's not always covered.
Yeah, I figure we'll go through everything and then I'll pop onto the Rice website and we'll talk about the things that we discussed that you might have challenges with getting coverage on.
Okay. Great.
Escrow, there's really not a lot you can do. I just want you to be aware that this is a top type of claim where, the transaction doesn't go through for whatever reason and somebody wants their escrow money back. You're not legally allowed to give it to them until the law says you can, but they still want it, so they sue you. Just common issue to be aware of. I don't know what you can do about it, frankly. Solar panels is a new issue. I think this one's really interesting. I had a risk management seminar that I did with a firm up in New Jersey, and this one sparked a lot of discussion within the office. Where I had my client had a transaction where the seller was going to take the solar panels with them. At the last minute, found out that it was way too expensive. She had no idea how expensive it was to take the solar panels. So now they had to include the lease cost of the solar panels in the sale of the home. The buyer could no longer qualify for the loan due to the increased cost from the solar panels, and the deal fell apart. And the buyer was upset that this wasn't originally disclosed because now they can't qualify. So solar panels is something everybody should be asking questions about, especially nowadays. And I don't know if Colorado has any specific laws on this that you might want to talk about, Damian, but it's a hot topic.
No, I will say that if you haven't taken a red line class, you need to do so because a lot of the work on paragraph 2, paragraph 10 were done regarding solar panels to give more guidance for brokers as to how to deal with those. But yeah, it's worth taking a class on solar panels if you see those regularly in your practice to understand, how they work and how the companies transfer them and what the costs are and qualifications and all that good stuff. So we're hoping actually for Cox Education to launch a solar panels class here at the beginning of the year.
Nice. Yeah, I would strongly recommend if you see solar panels in your transaction and you don't know what to do, ask your principal broker and find out. So wire fraud is not covered through real estate E&O policies. I know Jill said that there's going to be a presentation about it. It is one of the major areas of concern. And the only comment that I would add on wire fraud is that be aware that you don't have coverage under real estate E&O, and if you want coverage, you have to buy a cyber liability policy for it. And 2, wire fraud has nothing to do with you asking somebody to wire money. The most common thing I get from clients is they say, well, we don't ask anybody to do that, so not a big deal for us. Wire fraud is when your systems get hacked. Your agents click on an email that they shouldn't have clicked on, a spoof email. somebody gets access to your information. They reach out and contact your client posing as you, telling your client to wire funds. That is third-party wire fraud. That's 99% of the reason real estate companies fall prey to wire fraud, and it has nothing to do with what you do other than your front-end education with the consumer to say, people, I am never going to ask you to send money. If anyone ever does, you must call to authenticate it. When you call to authenticate it, do not use the phone number in the email or the phone number from the person who just called you. Use an independent source to verify that it is authentic. And wire fraud is 100% preventable. It's really just sheer laziness on the part of banks that they don't want to add this extra layer of difficulty in closing a transaction. But that's my 2 cents on wire fraud. All right, these are the things that are most likely to get you sued per transaction. Intermediary, dual agency, transaction brokerage, whatever it's called in whatever state you operate in. If you are collecting a commission on both sides of a deal, somebody is going to allege that you closed that deal and didn't disclose something because you wanted your money. And the more money that's in, the higher the chance that they're going to be able to allege it, true or not. But it's really easy to say, really, you didn't know that my offer wasn't the highest offer. You didn't tell me to put an escalation clause in my contract, but you told them to put an escalation clause in their contract. You wanted 6%, 5% commission, so you made sure my offer wasn't as high.
Let's not talk about
offer.
percentages of commission, Paul, ever again.
All right.
Thank you.
Well, this is so it's a really hot issue. I'd say somewhere around 60 to 70% of all the claims that come in my program are when the office was on both sides of the deal. And to put that in perspective, most of my clients have at maximum 25% dual agency. So if at most 25% of the transactions are dual agency and it accounts for 60 to 70% of the losses, that speaks volumes about how prevalent those claims are.
Yeah, not good odds.
Yeah. And in fact, the states where they don't call it dual agency, Florida, Texas, New Jersey, there's a bunch of states that call it intermediary transaction brokerage, are the states that we have the highest incidence of claims from dual agency, which goes to really the root of the problem, which is the same problem that happened in 2009 and 2010, where there was a huge rush of claims on foreclosures because everybody thought, well, as is means as is, and I don't have to do anything. When you don't think the exposure is there for you, you're not as careful to make sure you're watching everything. And that's what I find on the non-dual agency states. They say, well, we don't actually represent both sides, so our duty is not to that person. And so maybe let your guard down a little bit, and it causes a lot of lawsuits.
And we're transaction brokerage, so that could be us. But
okay.
I must say, I really love your next one.
Yeah, I figured you're gonna like this one. So this is number one. There's nothing even close to. If you sell to or for an attorney, your chances of getting sued on that transaction are higher than anything else you could possibly do in real estate. That's the number one. It's not a protected class, so if you want to tell Damian,
yeah,
you could from you.
Yeah,
now,
you could discriminate against lawyers. You say, "Yo, you're a lawyer. I don't want to represent you."
They know the law. They know if you're doing something wrong in the transaction, they know it. They'll exploit it. I find a similar situation when you're selling to sophisticated commercial buyers on commercial transactions. They probably know the commercial real estate laws better than you do. In fact, most of the time I see residential agents doing commercial transactions, or people that don't have a lot of experience in commercial, and the commercial buyers and sellers have a lot more savvy about the laws. I think selling to or from or for an attorney puts you in the same circumstance. Agents giving out loans, my advice is don't ever do this. It's really risky.
No, that's not a good idea.
Agree with this? Yeah. And then I think this is the last one on the risky transactions, estate sales. You're combining death, family, and money in the same transaction. They're very volatile, huge number of transactions of my claims are from estate sales. Just be really careful. One of the claims that came up that I thought was interesting, there was a family, there were 4 kids. One of the kids was in charge of making sure the home got sold. They sold the home, and then the 3 other family members came back and said, well, you didn't get my approval. I don't want to do this deal. I don't want to sell this house. And so, something I wouldn't have even thought of, that if somebody steps forward as acting as the executor to the estate, that you then have to get the sign off of the rest of the family members. Just be aware that it is volatile. It's going to lead to more claims. Ask questions.
Paul, there was a question that came through on that last slide. So can you clarify, are you referring to agents who are also loan officers providing home loans, or agents providing loans for money during the transaction?
Agents providing money to the sellers to maybe fix up the home and say, if you give me, I'll give you $100,000. I can fix up your kitchen and your master bath. We can sell the house for $200,000 more. It's sort of along the lines of what wholesaling is, but you're giving a loan out essentially to the seller. And then you get situations where the seller doesn't want to sell. They don't think it's the right price. Now you have an ownership interest in the property, and you say, well, if you don't sell it, I'm going to foreclose on it. It causes a lot of bad situations. But yeah, personally giving out loans, not acting as a loan officer for, a bank or a mortgage company or something like that.
I think there was another question here too, Paul. Let me just ask a couple more if you don't mind. So maybe too early. This says, I've always been told brokers shouldn't investigate these disclosures, and how are brokers liable in the end with these claims? I think we probably ought to talk about the fact that everybody's just sue happy. And what I've seen with my clients is that it doesn't matter whether, I can't tell you how many demand letters we send back a denial based on the fact that they said, oh, well, you didn't meet your standard of care because you should have done some preliminary investigation into X, so therefore we're going to sue you. And we'll send a denial letter, but it still increases the loss run. And there's still some lawyers out there, they'll still sue you. So that's how you get dragged into these things, even when you don't have a duty to investigate. Like Paul is saying, I don't personally think you should be investigating and going, hey, let's get our inspector over here and I'm going to go through with them and make sure they catch everything. That's not what I'm saying. But it'd be nice to have a paper trail where you sent something to the seller that told them, make sure that you review the seller's property disclosure very carefully, and that you understand that you need to disclose anything that might be material about the property. And keep in mind that what you might find immaterial, a buyer might find material, and you've never been sued. Nobody's ever been sued for disclosing too much. And just have an email trail of telling the seller that they really have to take this seriously about disclosing, and not just sign the blank form and send it back over to the buyer. And if you have an email that at least says that, at least that'll help if the suit comes to say, if they start doing it, say, look, we didn't know anything about it. In fact, we gave the seller advice that they should be making sure that they disclosed everything. And hopefully that puts it between the buyer and seller at the end, instead of dragging in the brokers because they have E&O insurance. So it's not going to stop everything, but it's something that can help. You have anything to add to that, Paul?
No, I'm with you.
The other one that I saw in here was somebody asked, so what's the best practice when involved in an estate transaction? I'm going to say just to document everything and make sure that you've documented that what you're doing is based on what you've been told by the personal representative to do. So that if somebody comes back and claims you didn't get my permission or something along those lines, you can say, I was told that, I was provided the letters. I was given the appointment of the PR. I was told that they had full authority. Here's the emails where I ran everything past them. You just want to document your file carefully, particularly when you're dealing with estates and lawyers. So.
All right, this is one actually, I think Damian, this is one that you told me about. These are just some claim scenarios, real world examples that have come up, but I think it was in Colorado where somebody sued because they had an assistant's pet and it was an iguana, like an assistant's iguana that a doctor had prescribed. Was that from you, Damian?
It could have been. I don't remember. I get so many of these wacky things. I forget which one's which. But I think there was a case where, and it was an emotional support animal. I don't think it was iguana because I don't think iguana qualifies, but it was something crazy like that, like a monkey, or I think it was a monkey that they got sued over. So.
So, well, the purpose of this slide is just to make you aware that there are people out there whose job it is to entrap you into saying something that will lead to a fair housing discrimination claim. That's what they do for a living all day long. So when you pick up the phone and answer these calls from customers and prospective buyers, just be aware there are people out there doing this. I had a claim down in Georgia, I think it was, or Louisiana, where a seller was selling a property for her best friend. They lived in the same town for 30, 40 years. The agent thought she knew everything about the property because she was her best friend and she knew she was over her house forever. And the buyer asked if they ever had any flood damage, and the agent said no. And it turns out they had flood damage. And the moral to that story is simply don't make disclosures for your clients. Make sure that any disclosures made are by your client and not by you for them based on what you believe to be true. Yeah, this is what I talked about a little bit earlier, but I had an agent down in North Carolina. Gentleman bought a home specifically to use as a golf rental. A month prior to closing, the HOA changed the rules saying they no longer could use the property for short-term golf rentals. And then the guy bought a property that he couldn't use and sued and won, of course. So just be aware of HOA changes. And this came up yesterday again. So this happens a little more than you would think. This is when your company or you resell a property that you previously sold and you have knowledge about something that you don't disclose the second time you sell it, but were aware of it the first time you sold it, you can be sued for not disclosing that the second time you sell it. Damian can throw some input on Colorado law, but for sure, if your firm has sold a house previously and somebody disclosed water damage, which is what happened in the claim yesterday, and then the new buyer who's had it for the last 5 years didn't experience that water damage and therefore didn't disclose any water damage, company still knew that there was previous water damage and didn't disclose it on the new sale. Damian, any Colorado specific?
I haven't heard the one where the
that?
knowledge has been imputed to the brokerage firm. I don't know if that'd be a colorable claim in Colorado or not. I have seen instances where the broker is selling the property again. He helped the buyer buy the property, and then he's turning around and selling the property. And then they're like doing the disclosures, and he has the old file. I need to go back and look at it. But if you're selling a house that your client owned, I would certainly say, let's go back and look at the file and produce what we were provided to. It's again, you don't get sued for over disclosure. So that's why I would do a seller's property disclosure that's new, but also maybe, supplement it with whatever the buyer has from the previous purchase.
We'll skip over that one. It's not too relevant right now. These are just some areas to be careful about. Business brokering, no E&O policies cover the promises, guarantees, warranties, projections of future profits of a business, which really is the number one thing you could possibly be sued for when selling a business. So just be aware you cannot get insurance for valuations, promises, projections of future profits of a business. Can get coverage on very select policies for business brokering, which might have to do with the real estate portion of a business opportunity. And we'll get into some differences in coverage at the end of this when we talk about what's missing from individual agent policies versus firm coverage. But it's risky stuff, and just be aware. Wholesaling, don't do it. My wholesale advice, don't do it. Flipping, just be very careful when you buy investment property and fix it up and sell it. You're going to be held accountable to a tremendous standard. Anything that goes wrong with that property, if you've done a fixer-upper, is going to be imputed on you. So just be very aware of that. There's sort of an inherent conflict in buying a property, hopefully below market value, so you can turn around, fix it up for not a lot of money, and then make a big profit on it. That whole premise can lead to what we see, which is claims where somebody says, you didn't correct all the things that you knew needed correcting because you wanted to turn around and make a profit on this. You knew the AC was on its last leg and you did nothing. You knew that roof needed to be replaced and you did nothing. I just see so many claims on flipping. Just be careful. Team LLCs, please don't use the LLC actual legal entity name. If you're working for another brokerage, you can use the team DBA. I can say the Paul Bondy team in my business cards, in my letterhead, in my marketing materials, but I don't want to say the Paul Bondy team LLC. For those that have team LLCs, the LLC is not performing real estate services. It's simply collecting commissions on the back end for tax purposes. Do not want to advertise the actual LLC. And maybe this is a good time to get into the.
Yeah, I think what we should,
comparison,
since you've talked about some of these top claims and everything that we're seeing, I think it'd probably be good for people to understand. So right now, Paul, we're in November, and in Colorado, most people's E&O insurance renews January 1st. I know all of my clients with you renew January 1st as well, but that's typically the state policy and the rights that you're going to go over. It renews. And I think a lot of people online would like to know, with these exposures, there's a lot of endorsements that they need to be aware of, because not all E&O insurance carriers are created equal and not all endorsements are created equal. So could you kind of go through some of the holes that you see in some of these policies and where people should be looking to plug them?
Yeah, let me pull up. Okay. This is Rice Insurance website, so I thought it'd just be more instructive to go right through what the state offers. So there's 3 providers that do individual agent coverage, where the agent themselves go out and get a policy, and then the brokerage firm can go out and get its own policy as well. These are low limit policies. The one we're looking at here on your screen is the Rice policy. It's mandatory. Not only are you required to carry E&O in your state, but because you're required to carry it, they're required to make it available. Really, the only problem I have with this is that they don't explain that because they've made it available does not mean it's everything that you might need or want. It is simply a much more bare bones, low limit policy because they are required. They're making you get it by law, and therefore they're required to offer it by law. It's sort of like flood insurance. If they tell you you have to have it, they have to make it available. So if you go and get an individual agent policy and you had 100 claims last year or no claims in 100 years, you get the same coverage at the same price. And in order to make that viable without filing for bankruptcy, they have to remove a lot of the coverage. So the difference between getting individual agent policies and firm coverage is that the coverage is much more robust because a firm underwriter can reject a client and they can rate according to claims history, whereas individual agent policies do not.
And
so I'll just walk through some of the coverage differences.
You mentioned individual policies and firm policies, and I know we've discussed it before, but can you just do a brief overview about those 2 different coverages, as how they work?
Yeah. So individual coverage follows the agent and not the company, or broker and not the company. firm coverage follows the company and not the broker. So what it means is when you buy an individual policy, it covers you wherever you go. Same policy, $100,000 per claim, $300,000 per year, unless you buy higher limits. And then a firm policy is going to cover the company and any agents, brokers, and independent contractors working on behalf of that company. So it's not going to cover things that anybody did before they joined that company or after they leave that company, whereas an individual agent policy is going to follow that agent wherever they go, but they're going to get less coverage by doing that. That's the trade-off. So some of the differences that you'll find, one, instead of a $100,000 limit that you get on individual agent policies, on firm coverage you'll have $1 million per claim. You won't get copyright or trademark coverage. So if you guys put up a picture on a listing and you weren't supposed to use the picture, that won't be covered on individual. Something like that gets covered on firm. Bodily injury and property damage. So if you sell a house and it has mold and somebody gets sick, you're showing a home and somebody gets bitten by a dog, or you're managing a property and somebody falls downstairs in disrepair. None of those things get covered under individual agent policies, but they do get covered under firm coverage, a good firm policy that is, at full policy limits. Let me see if Colorado.
Can you go back to the top
buyback
real quick? I want to point something out in this, you know, because the basic policy is a 100-300 aggregate policy. And I'll tell you, $100,000 for a claim these days is really not that much. So if you guys are doing individual policies and you're looking at those limits, and the three that I know of that are doing it in Colorado, and there could be others, are Rice, Williams, and Kress, or I guess Gallagher now, whatever they are. And but you want to make sure that you have coverage. And to me, the 100-300 just isn't enough. You could burn through that coverage because it includes attorney fees fairly quickly. And so you might consider when you're pricing out your E&O insurance about getting one of those higher limits.
So in Colorado, you can buy this endorsement I'm highlighting here. So for $30 per agent, you can buy $10,000 worth of limit for a bodily injury or property damage claim. I find that to be woefully inadequate. If you got sued for a bodily injury, if there was mold in a home, lead, poison, this is just not adequate limits. But you can buy that endorsement under the state program. Below that, construction development. If you are building homes from the ground up construction or developing land and then selling those properties, you need this endorsement to have coverage for those transactions. It's called construction development coverage. And you can buy a $100,000 limit for $250 per agent through Rice. This also, by the way, applies to flipping. So if you're doing investment properties and renovating them and selling them, that counts as construction development. So you'd need this endorsement if you wanted to sell those and have coverage.
Before you move on to some of the other, Paul, before you move on to some of the other coverage, I had a question here that says, if I move companies and insure with a different company, but a claim comes up from when I was with the prior company, does the old policy cover any claims under the old company, or do I have to insure with the same company to get continuous coverage? And this comes up a lot with and somebody asked about firm policies versus group policies. I often refer to them as group policies. Paul's calling a firm policy. They're synonymous. But would you talk a little bit about this as far as particularly, because a lot of this depends on, is the old company on a firm policy or are they on individual policies?
Yeah, it's really nuanced. So I use the word firm because the state program calls themselves the group program. So that's why I steer away from the word group, because if you look on the top of the Rice website, it says the group policy. So what I do is firm coverage, where I insure the entity and any agents, brokers, independent contractors working on behalf of that entity, versus the state or group program that covers the individual only. So yeah, the question is nuanced, and it depends. So if you have an individual agent policy and you go to a company that has a firm policy, you will automatically be covered under that firm policy for anything you do on behalf of that new firm that you go to work for. And if you are concerned about things that happened prior to joining that new firm, you would buy what's called tail coverage to pick up the prior transactions that you performed that you may get sued on in the future. If you're going from a firm policy where you're working for a brokerage that has firm coverage and now you want to buy individual, you would just buy the individual policy to buy for coverage for anything you do after you left the company with which you had firm coverage. And the company that with which you had firm coverage will continue to cover you for anything that you did on their behalf, even after you're gone.
And even the new policy, if you can show continuous coverage, will sometimes also pick up the claim as well.
That's right. Right. But it's really nuanced. I don't know that I can go over all the permutations.
No, I think the
here,
important
but
I think the important lesson here, guys, is that if you are changing or doing something, you need to, number one, know what your coverage is now and and then if you're moving, find out what your coverage is going to be and make sure that there isn't a hole somewhere. So call the existing carrier of your coverage and find out what it's going to cover and make sure that you know what coverage you're going to have placed. Because I have seen people leave and not have coverage. I've seen people give up their coverage and not have coverage. I've seen people not renew on time and not have coverage. And keeping your coverage in place is very, very important. So make sure that you're checking on that whenever you're, first of all, make sure you renew immediately when you're renewing your policy. Do not wait until March, because then you'll have problems because you won't have continuous coverage, which means they can not deny your claims on your individual policies. So make sure that you actually are renewing in December and January. And then also when you're doing that renewal process, as Paul's going through these endorsements, you can see all these different add-ons and doodads. Make sure you're getting the endorsements that you need for the business that you're doing. So with that, Paul, why don't you go ahead, and I think there's probably more questions, but I think we should probably at least cover some of these other endorsements that they need to be aware of.
yeah, and just to put a pin on what you were saying about making sure you renew the coverage, just be aware, once you let your coverage lapse for real estate E&O, you cannot get it back. The minute you let your coverage lapse, everything that you did in the past, you cannot get coverage for. I'm talking about individual agent policies now. There is no way to get it back no matter what. So a few more of the differences: regulatory complaints coverage, you get $2,500 on an individual agent policy. On a firm policy like the one I offer, you get $100,000. Lockbox coverage, you get $100,000, and it's only for property damage. On a really robust firm policy, you get $1 million, and it covers not only property damage, but bodily injury from lockboxes. And in fact, the better policies don't even require you to have a specific type of lockbox. It can be any lockbox or no lockbox at all. Now, a frequent question I get is, does it matter what kind of lockbox I use to have coverage? And the answer, if you have an individual policy, is yes. So if you were to show a property in the homeowner's home, and so you knock on the door and they let you in and you didn't use a lockbox to go in, you don't have lockbox coverage. In other words, there's no coverage for any property damage that might occur in that showing because you didn't access the property through a lockbox, through this entry device. Fair housing discrimination, you get $30,000 coverage on an individual agent policy. Normally, you'd get $1 million of coverage on firm coverage. Let's see what else is interesting. Property management would automatically be included on firm coverage. You have to individually pay to have that coverage. It costs $25 per agent. And when you get it, you don't have any bodily injury or property damage coverage, which essentially means you have no coverage, because I'm not sure what the property management claim would be that didn't involve bodily injury or property damage. So if you buy property management, you have to then buy contingent bodily injury property damage to get your bodily injury property damage. So you'd have to package those two together. So you basically get $10,000 worth of property management coverage on an individual policy, which again, I think is woefully inadequate. And I won't go through and sort of trash this because it has its place. It serves a function, which is somebody who thinks I'm really small. I'm never going to be sued. I'm buying it because somebody's making me buy it, and I just want to have evidence of something. That is really, to me, what this satisfies. But if you're a sophisticated broker, you have a brokerage firm, I would strongly consider, whether through me or anybody else that offers firm policies, that you at least investigate it. I think it's just a much better option to put the onus of the coverage on the brokerage firm to make sure they're doing it right than to count on the agents to make sure they remembered to buy all the endorsements that they needed or to renew their coverage on time. And one other thing I want to say about this, because I see this a ton, you always want to have coverage if you buy individual through the company that provides the excess coverage for your brokerage firm. So if Rice is doing your excess coverage, you want to buy your individual policy through Rice. You don't want to go to Crest and buy an individual policy if Rice is providing your excess. Remember that the excess is excess of the primary. It is only giving you coverage that they would have offered in the primary coverage. You can run into a situation where somebody offering primary coverage is including coverage, like Crest, for example, offers some coverage that Rice doesn't offer. That excess policy that you buy through Rice will not cover the things that you have on your Crest individualization policy if Rice doesn't already cover those things on their individualization policy. That was probably a little confusing.
Yeah, that was a little confusing. Let me see
But-
if I can boil it down. Is that if you're going to do an excess
Sorry.
policy as a brokerage firm, make sure that you're checking to see what it's going to cover, because it may not cover everything on your brokers if the underlying policy doesn't cover it. Paul, one thing that did come up here that I saw in the questions was, the individuals brokers or the small brokerage or the boutique brokerage firm that has just a couple agents. Doing a firm policy just is a bit cost prohibitive at times. You and I have quoted some out for a couple of my clients that are smaller, and it just financially wasn't going to work for them. So in those instances,
unless they need a million limits.
Yeah.
Unless
Yeah.
they need million limits.
Yeah. And if they may not need that or whatever. The advice here, guys, is get at least go through your endorsements, and you can see that there's a lot of add-ons here. So when you're comparing dollar to dollar, first of all, I would investigate a firm policy, and maybe it works out the same if you start adding in all these endorsements and seeing how much cost there is to these. You see this endorsement bundle, which is a good one for, I'll let Paul talk about it, but there's a good thing to put in there too, which is, here's $15 here and $55 here, and this amount here. It starts to add up, but I would definitely make sure that you're reviewing these endorsements, because I've seen too many brokers that are left out in the cold because they're doing fix and flips and didn't put the CD coverage on their policy. So, keep those things in mind.
Yeah, I'm not sure I had anything else to add on the state program. You have more questions?
Yeah, there were several questions that popped in, so if we can rapid fire these at you. So do you know who carries insurance for cyber liability?
Who the underwriters are? Yeah, there's.
Who do they go to, Paul, to get it?
99%.
I think they want to know who to go to get it.
You'd go to an insurance broker who knows what they're doing with cyber liability. How do you know that? I'm not sure. There's only 4 or 5 carriers that cover third-party wire fraud, and then there's 1,000 cyber liability policies that cover everything except third-party wire fraud. So it's hard to find the policies that actually cover you for the thing you care about. So finding a local specialist is really what's important. I can tell you some names of the carriers that do it well: Chubb, Coalition, AdBay. These are the better companies that really provide a robust policy.
Paul, do you place these policies?
If I do the real estate E&O, I do. As a standalone cyber, I don't.
Okay.
I guess I'm happy to help anybody if they want to call me and say, what do I do? Where do I go? I'll direct you to a good place, but I really don't just write standalone cyber.
Okay. And then go ahead, honey. I'll let you go through the questions.
Okay, what is the process in which E&O kicks in? Is it only during a lawsuit?
No, it's a great question and something you all should be aware of, that you need to report disciplinary proceedings, complaints to the real estate commission, demand letters, threats, and formal lawsuits. All of those things are required to be reported under the E&O policy, no matter which policy you have, individual or firm. You are required to report claims or potential claims that you become aware of during the policy period. And if you ever have a question about whether it's something that rises to the level of knowledge of a potential claim, call whoever is your insurance broker and ask them.
What happens when you retire? Do you need full coverage?
A very personal decision. Usually, if you have an individual agent policy and you retire, it is simply based on your risk tolerance of how long you want to have coverage for. We call it tail coverage, to protect you for prior transactions that you performed. You want to have coverage for a year, 2 years, 3 years into the future. How long are you going to be worried about things that you did in the past is how long you want to have tail coverage for. It's just a personal decision. There's no right or wrong answer. Generally, the statute of limitations is what is it in Colorado? 2 years?
It's 2 years for tort, 3 years for contract.
Okay. So
And
a lot
Paul,
of people go by that.
You once gave me numbers about the total number of claims that were reported in 1, 2, and 3 years. Maybe that would help people help them understand how to make that decision.
Yeah, 90% of all claims come in within 1 year of the transaction close date. And then, the rest are stragglers after that.
Yeah, it's like 95% in year 2 and 98 in year 3. And then there's this 2% chance that you could have one in year 15, which I actually have one going right now.
Yeah.
When the brokerage firm pays for our individual coverage, are we able to pay for increased coverage directly through the insurance carrier?
No, not individually. You can have the brokerage firm itself increase the coverage, but you can't individually have increased coverage when you have a firm policy.
You can always get a secondary policy if you don't think that the firm policy is enough.
That's true.
Let's see, Paul is saying that individual policies are inadequate, but that firm policies are more robust. Can an independent agent purchase a firm policy even if you are one person?
So yeah, sole proprietorship can. So you have to be an entity to buy firm coverage. You can't be a broker working for another brokerage firm. So, but if you are your own firm, if you're a sole proprietorship, sure, you could get firm coverage. But as Damian mentioned, it can be cost prohibitive on the really low end. If you have 1, 2, 3 agents, no vendors are requiring you to have $1 million limit. If you go through the state, it's $229 an agent to get a 100,000 limit policy. The minimum premium in Colorado for firm coverage is probably $1,500. Now, if you needed $1 million of coverage, then you'd have to buy what's called excess coverage through Rice, and that would be cheaper to buy firm coverage. But if you just need minimum limits, it probably wouldn't be worth your while. But yes, I can write sole proprietorships, just not agents working on behalf of another brokerage.
And it's worth going through and doing the exercise of looking at the endorsements and the coverage that you get through one policy and figuring out what the coverage looks like as far as different to do the other policy and find out if the additional cost justifies it.
And I should say that the state program may be inadequate. I don't want to get in trouble here. It may be perfectly adequate if you get sued for the things within the limits of what they cover.
What if you change brokerages and have carried individual for years, but the new brokerage uses a different company?
So that
The new
depends on whether
brokerage
it's a
has
firm or an
firm.
individual policy. Just because the new company might be doing a different company individually, you probably still would have to do your still own individual policy. But Paul, why don't you talk about changing policies? Because I get this a lot of times, as whether or not it changes coverage.
Yeah, so a few different scenarios in that question. I'm not sure which one it is, but if you had a Williams Underwriting Group individual agent policy and you move to a brokerage that has a Rice excess policy, my advice would be to go and renew with Rice on an individual agent policy because the new brokerage has excess through Rice. I would follow whoever is writing the excess for that brokerage. If you're moving to a brokerage that does not have excess, you can just renew your policy with Williams or whoever you have your individual agent policy through. If you have an individual agent policy and you're moving to a company that has firm coverage, then you need to buy tail coverage if you're worried about your prior transactions from whoever you're writing your individual agent policy through at the time that you make the move to the company that has firm coverage. But that firm coverage policy will automatically pick you up for anything you do on behalf of that firm and that firm only. Hence,
Which provider has the most comprehensive individual policy?
probably Crest out of the individual providers.
Well, Williams isn't bad. They've picked up some more of their coverage, but it's always seemed like Crest had better coverage to me too. But I think they're winding theirs down. Somebody posted that Crest won't pick up a broker that sells houses in excess of $1 million, which in our market is going to exclude a lot of brokers.
This person asked, if there are only 2 agents in a brokerage firm, do we need 3 policies, 2 individual and 1 firm? This is what we were told maybe from Crest.
It's not a firm policy. It'd be an individual policy for the brokerage firm, but you would need 3 policies. It's just 3 individual policies, 1 for the brokerage firm, 1 for the employing broker, and 1 for the broker associate.
What is the statute of limitations? I guess it depends on the issue.
We discussed that statute of limitations on contract. I think it's contract is 3 and tort is, or negligence is 2, but it could be reversed. What you need to know is they'll sue you on the 3. So if the other one is expired.
So I think we kind of covered this, but maybe if you can re-clarify, if a brokerage is offering the policy, some firm policy, do we as an agent need an individual policy?
Possibly, a little nuanced. I would say only if you're worried about 1, transactions that you performed prior to moving to that brokerage that has the firm policy, or 2, you're performing real estate services outside of the company, outside of that firm that you work for. So if you were doing, and I don't know what Colorado allows you to do, but I think Damian said you can do property management on your own properties, and you could potentially do that outside of the brokerage under which you hang your license. You may need coverage individually for those transactions if you're not performing it underneath the brokerage. Or maybe you do BPOs or auctioneering or appraisal or something like that outside of the brokerage. And so those things won't be covered under the firm policy.
DORA requires independent brokers to buy the policy in the name on their license, not a DBA. Do you have any advice?
First of all, guys, your licenses are personal, period. So when you're buying a policy, you have to buy it for yourself personally. Your entities for your teams or whoever, they do not sell real estate. They are not licensed to sell real estate. You cannot hold them out as an entity to the public. That's what Paul was talking about with those teams. So if you're an entity, if you're a brokerage firm that's licensed with the division, then you can buy it in the name of the brokerage firm. But if you're licensed, you have to have a policy for you individually, because there is no such thing as your entity. It does not exist in their eyes.
As a brokerage that specializes in property management, if the brokerage policy is for $1 million with all the endorsement Do licensees who work for the brokerage need the higher limits, or is a basic policy enough? The brokerage gets sued, not the property manager generally.
Well, if you're doing property management and you have an individual agent policy, I'd say you need to be really careful because the limits are extremely low on the only thing you'll be sued for in property management, which is a bodily injury or property damage claim. If you're going through Rice, the maximum you can get is $10,000 per claim, and that's just not going to cut it. So if you're doing property management, my advice is get firm coverage. Don't mess around with individual agent policies. It's way too much risk. So you'll get $1 million of coverage for the thing that you actually are worried about if you're doing property management.
Can you get the construction development add-on for an individual policy, or is that just a firm add-on?
No, it's an individual you can get it add-on. These are all individuals that are on the screen now.
It's limited.
So it's $250 per agent. It's a $100,000 limit. And it also, one of the things I didn't even recognize until 6 months ago is that it's only covering your spouse. So if you are building a property, it's not covering you. If your spouse is building and you sell it, it is covering that. But if you build your own property and sell it, or develop your own land and sell it, then you can then you're not covered under this endorsement, even if you went out and paid the $250 for it. It only applies to spouses.
Yeah. So make sure if you're doing it yourself, make sure you check some of the other individual policies and see what their endorsement reads and see if it's better than this.
There was a comment here that Crest significantly increased their coverage costs due to claims in the prior years for agents producing GCI at 150,000 plus. Cost increased from $200 per year to over $800 per year.
Yeah, that's what Paul talked about with the lot of claims.
Can you get tail coverage if you do not have an active license?
Question. I would assume you can, because the tail is covering you for things when you did have an active license. My thought would be yes, but you'd have to check with whoever was writing that policy for you.
It's all dependent on timing too, I think, because what a tail policy really is an extended reporting period. And so if you went inactive in 2021 in July, you still have a policy that's active through December 31st. You could get the tail at the end of the year. But if you tried to get it in March of 2022, they're not going to give you a tail.
Right.
Okay, well, we're about 10 minutes after 3 and I think we answered all those questions. So thank you so much, everybody. If you have follow-up questions, feel free to shoot those to me and I'll get you in touch with Paul. Thank you so much, Paul, again, for all your time and expertise. You're an incredible resource. We really appreciate you spending over an hour of your busy day with us. So thank you so much. And thank you so much, everybody, again, for spending your time with us this afternoon. We really appreciate you joining us, and please think of Heritage Title on one of your upcoming listings. We would love to work with you. Thanks, everybody, and we will talk to you very soon. We'll see you next time.
Thanks, Paul.
Thanks. Bye, guys.
Bye.